The objective is to provide exposure to institutional quality real estate in a portfolio that's diversified by property sector and by region for our underlying investors. We focus our investments on the real estate component of these companies, first and foremost as primary drivers of total returns. We invest in some of the world's best property companies in terms of portfolio quality, in terms of market exposure. So for instance, we invest in a company called Shaftesbury, which owns prime high street retail real estate in central London. We have exposure to a company called Empire State Realty Trust, which owns the iconic Empire State Building in New York City. We invest in a company called Sun Hung Kai Real Estate, which owns prime office and retail, as well as residential businesses in Hong Kong, with exposure also in mainland China. So really we let the stock selection drive the portfolio construction, ensuring that it's diversified, as I said earlier, by sector and region. We really focus on real estate as the key determinant, filtering out companies that are highly leveraged, companies that are not exposed to high quality locations, and companies that just don't seem to have sustainable, durable revenue collection business models. Our exposure to the U.S. is really driven by the opportunity set. The U.S. market has the largest and deepest listed property securities market in the world. We have excellent investment opportunities across all major property types, whether it's office, whether it's industrial, whether it's rental housing, retail, as well as some of the more peripheral property types like data centers, manufactured housing, student housing, single-family rentals. We find the U.S. has terrific investment opportunities. So we get asked the question often about what the implications of higher interest rates might be for listed real estate in the U.S. and elsewhere around the world. And I think that there's a few things that are really important to consider in this situation. One is, what are the conditions that would cause rates to go higher? If in fact it's because the growth profile of the economy has improved, that should translate into improved demand for real estate, occupier demand, more office workers, more consumer spend for retail, more housing demand, more flow of goods through warehouses. So we think it actually could be quite supportive for tenant demand. The real question becomes, and it's always been the case, of getting the supply and demand calculus correct for real estate. So we're trying to orient the portfolio to be in markets and with companies where landlords are going to have more durable pricing power because supply isn't going to outstrip demand. So we're vigilant against construction levels and monitoring them, because as long as landlords have the ability to to drive prices, they're going to be able to pass through higher interest rates and the inflationary effects to their tenants via rent increases. And so making sure that you're exposed to markets that aren't oversupplied is critical in this situation. One area that we're particularly focused on right now is understanding the competitive challenges that retail real estate currently faces due to the growth of e-commerce as a viable outlet for consumer sales. We've seen surveys that expect that e-commerce is going to account for nearly 20% of retail sales in a number of markets, such as the US or the UK, over the next 1 to 2 years. This is having a real dampening effect on the business models of traditional physical store retailers. It's particularly acute right now in the US for 2 reasons. One, the US malls have a much higher component of fashion retailers than many other markets around the world. If you go to walk malls in the UK or on the continent or in Australia, you'll see that there's a much broader diversity of tenants in those properties than there are in the US, which really have oriented and skewed themselves towards fashion retailers over the past several decades. These retailers are feeling acute pain right now from the shift to e-commerce and the change in consumer patterns. US malls also have a significant exposure in terms of space to department stores. department stores represent about 45% of the square footage leased at regional malls in the U.S. It doesn't account for 45% of the income because oftentimes the rents are quite low. But it does mean that as department stores look to shed space, and we've seen a numbering in the hundreds of department store closures that have been announced or expected over the past couple of years, and even more that are expected over the next several years. As we see department stores shed space, landlords are going to have to expend quite a bit of capital to reposition those properties. In some cases it'll be profitable, but in many cases the volume of space is likely to overwhelm landlord capabilities. And so we're quite concerned about the store rationalization that's underway in the U.S. The fund has increased its exposure to logistics companies in the past 6 months. We've done this really as an anti-retail exposure. Just as e-commerce has impaired or is impacting negatively physical stores, it's actually boosting demand for logistics and warehouse space as more goods flow through warehouses rather than flow through stores. One segment that's particularly interesting to us is the last mile distribution. These are locations that are proximate to the end user, and e-commerce is increasingly focused on distribution to their consumer directly in a real-time, quick basis. And so it's a situation where location is trumping obsolescence, and central locations provide good distribution options. So the fund has increased its exposure to logistics companies quite a bit in the past 6 months. I think supply is a concern that we're constantly monitoring in the construction of our portfolio. We are now 6 to 7 years in rebound from the GFC. We've seen occupancy increases across many of the major asset classes. We've seen rents rebound considerably, and we've seen developers start to become more active. It's not a widespread concern yet, but it's something that we're definitely monitoring and we're being vigilant against. We've seen supply start to impact rent levels in multifamily in the U.S. We've seen it start to impact rent levels in self-storage in the U.S. It's started to impact rent levels in office in London, and so we're really quite vigilant against protecting against supply incursions. We have invested in emerging markets in the past. We don't currently, because we think the risk-reward profile of the developed markets are really quite favorable. Specifically, I mean, this fund has always been oriented towards a developed market focus. These are markets that have some of the largest and deepest institutional investor demand for real estate. They have deep and established tenancies. They have the rule of law is well established. There are constraints to supply. So there's a number of reasons why we're attracted naturally to developed markets. Specifically to emerging markets and really to South Africa, these are countries and markets that we would consider and have considered from time to time. South Africa, we find, doesn't quite fit within the construct of what we're looking to achieve for our investors on a global basis. The stocks screen expensive relative to the underlying value of the assets. Most of the companies, with just a few exceptions, are diversified across property types, and we prefer companies that are really sector specialists and experts in just one property type. We can diversify the portfolio exposure at the company level rather than have the managements diversify it within the company. And then finally, there's a significant amount of capital that's being raised in South Africa and exported and invested overseas. And frankly, the risk-return profile of the companies in which it's being put to work is dissimilar to the risk-reward profile that we normally see. There are often markets where the tenant demand is less established and is thinner. And so we think the risk profiles are really quite considerable there. So it's something that at this point, at these pricing levels, we just don't see the merit of making an investment.